Welcome to our High Rock clients and any other listeners who have joined us this week. And thanks for taking the time to tune into our weekly webinar where we will talk about what we see happening in the global economy and financial markets and the world of wealth management and how all of this impacts our decisions on the best courses of action for our and your investment strategy. We are recording this webinar so that those who can't join us live can tune in when it is more convenient. I'm Scott Tomlinson, and I'm joined by my partner and colleague, Paul Tepsich, the founder of High Rock. Our financial planner, Bianca Tomlinson, is not on the call today, but we will have a question and answer period regardless at the end of the call. So if anyone has a question about any aspect of wealth management, we invite you to feel free to ask us questions. If you're a first-time listener and would like a little more information about our private client services and our disciplined investing strategy, we have a separate introductory webinar that will provide you with this on our website under the About High Rock tab. Well, let's quickly review our themes for 2016 before we get started on what happened over the last couple of weeks. Our key theme for 2016 is that financial markets will remain volatile. January saw a new spike in volatility, but markets have settled a bit in February, although uncertainty has not gone away. Financial markets are just learning to deal with it. There is a big question mark surrounding the U.S. economy. Will it follow the U.S. Federal Reserve's more optimistic outlook, or are less positive global forces going to pull it down? Q1 GDP forecasts are showing some improvement, but is this sustainable? Commodity prices, and especially oil, have been having a deflationary impact with its excess supply. Commodity prices have settled recently, and core inflation readings are picking up a bit. We'll look at that a little bit more in detail as we go through the presentation today. The central banks of Europe, Japan, and China are adding stimulus. The Bank of Canada, the Bank of England are holding steady at this point in time, and the U.S. Fed wants to tighten policy, but this has been a recipe for greater uncertainty, and now perhaps the Fed is rethinking its position somewhat. Geopolitical wildcards like the UK leaving the European Union, Russia and OPEC and oil prices, China, North Korea, terrorist activity, Syrian refugees, and the U.S. presidential election politics are all becoming a factor. As they always do, bond markets may hold the clues, or are central banks forcing negative interest rates, possibly distorting the picture? We'll talk about that a bit as well as we go through our call today. Well, as we say always and often, equity markets remain expensive, although somewhat less so than last May at this particular moment. We'll have a look at the latest readings from our equity market metrics. And of course, as we talk about often, we remain in a time of lower than average returns when after 6 years of above average returns, and as all things do over time, we are seeing them move back toward their longer term averages. Well, plenty has happened since our last webinar, so let's get right to the financial markets because there is plenty going on. Now, in keeping with our key theme for 2016, it has been a fairly wild ride since the beginning of the year. Volatility has declined over the last couple of weeks, however, although it was a little higher today. Market fears of debt defaults and bank repercussions have calmed somewhat, and oil prices have recently stabilized. Volatility remains well above the long-term averages, but well below the spike we saw last August and some of the previous spikes from 2008, 2010, and 2011. CNN Money's Fear and Greed Index hit a low near 9 in January. Now it is sitting right on a neutral level. As can be expected, oversold markets will recover. However, we are focused on what comes next. More on that coming up. Since our last webinar, our benchmark world equity index is actually stronger by about 3.75%. Is now lower by only about 6.75% on the year. last webinar 2 weeks ago, it was lower by 10%, so it has recovered some. Germany's Accenture DAX was the best performer over the 2 weeks, and Japan's Nikkei 225 was the worst performer. In December on BNN's The Close, I suggested that it might be a reasonable strategy for 2016 to be overweight the underperforming Canadian equity market at the time and underweight the outperforming U.S. equity market at that time for rebalancing purposes. At this time, that strategy appears to be working in my favor by about 4%. Well, after hitting highs last May near 63, our benchmark world equity index made new lows near 49 in mid-January, and then again about a week and a half ago. That's a 22% drop from the highs. It found buying support from short covering and a little value investing after such a steep decline. The downtrend, however, remains intact as we are now experiencing lower lows and lower highs. We could see buying potentially drive prices to the new downtrend line at or near 56 to test sellers, but a break of that line would change the medium-term outlook to positive. However, until this pattern and downtrend line are broken, we should be on guard for further selling pressure. We have been and will use better values to nibble away at this opportunity, although we are still sticking to our generally overweight cash thesis until we see more positive markets develop. The S&P 500 held support just above 1,800, very close to the long-term uptrend line, which would need to hold to keep the long-term positive trend intact. It remains to be seen if this is just a pause before more selling enters the market, or if some confidence is creeping back into the equity market. Certainly, we do not see value at current levels, as I will discuss in more detail later in the call, because the fundamentals are not enough to inspire us. In the near term, there may be some relief buying, but those with less confidence will likely use that as an opportunity to reduce their exposure to overpriced assets. Momentum, for the moment, favors the sellers. Canadian bonds are weaker and U.S. bonds are little changed. U.S. high-yield bonds were stronger and the Canadian Preferred Share Index was lower over the last 2 weeks. The Canada-U.S. interest rate spreads continue to narrow, now down to 64 basis points from 68 basis points 2 weeks ago, and a wide of almost 90 basis points in mid-January, before the Bank of Canada surprised markets by holding rates steady at its last meeting. Add the deficit and spending plans recently announced by the new Liberal government, and some concern over Canada's future credit rating may also be entering the equation. Oil was hit today after the latest Saudi Arabian denial of production cuts, but oil has jumped in value since we last talked. Nat gas, though, is suffering from warmer than normal weather in North America. Commodity prices are off their lows and appear to have stabilized, at least for the time being. Oil also stabilized, at least for the moment. Even an announcement by Saudis today has had only a minor impact to the downside. The downtrend line may get tested in the not too distant future. That may change sentiment if it is broken to the upside. Now, while it is hard to imagine, given the continued bearish chatter about supply, it could invite buying by those who are positioned to be short. The contrarian in me thinks that oil market participants are highly bearish and the least resistance may be higher prices. We'll see what happens and how that develops over the next few weeks. Well, the Canadian dollar has gradually moved higher over the last couple of weeks. Stabilized oil prices and narrowing bond yield spreads have been the catalyst there. 5 weeks ago, the Canadian dollar hit levels not seen since March of 2003, near 1.46 or 68.5 cents US. Now, since it has strengthened to test the trend line at or about 136 or 73.5 cents US. If it breaks through that trend line, it may get back to 130 or 77 cents US. What a swing that would be. But if we just think about how we saw the oil prices at or near their trend line, the Canadian dollar as well, being close to its trend line, they could very well work um, in sympathy with each other. So we'll watch for oil and its impact potentially on the Canadian dollar over the next few weeks. Well, our benchmark world equity index is comprised of about 52% of U.S. companies, so we keep a very close eye on what's going on in the U.S. economy. The U.S. Federal Reserve raised interest rates in mid-December and held them steady in January, citing that they saw improving labor market conditions and increasing household and business spending. But we're concerned with exports and global economic and financial developments, which is code for higher levels of volatility around the world. As you all know, this is our key theme for 2016. The next meeting is March 15 and 16. If current conditions persist, we think that this will keep the Fed from raising rates at this next meeting. Back in December, the Fed had a particularly optimistic outlook for the economy. The U.S. Federal Open Market Committee members suggested an average of 4 interest rate increases in 2016. We do look forward to seeing this updated in a few weeks. Well, the Fed's key inflation metric remains stuck well below target, which is 2%, and we will get the next reading later this week on this indicator, the Personal Consumption Expenditures Core Price Index. It is expected to move a little higher because after the most recent reading on the Consumer Price Index, which jumped higher in January, the core CPI is now a little over 2%. Well, after weeks of rising jobless claims, they have started to turn a little bit lower. We'll keep our eyes on the latest developments on the employment front over the next few weeks as well. Well, the consumer has been confident, according to the surveys, but there had been a significant gap between their confidence and their spending. The most recent data, however, has shown rising retail sales and declining consumer confidence and a narrowing of that gap. What are we to make of this? Well, uncertainty is eroding confidence at the retail level. However, improving employment and higher wages have been fueling spending. Vehicle spending continues to lead along with general merchandise. Interestingly, restaurant spending, which had been so strong throughout 2015, has slipped to begin this year. But high inventory to sales ratios have preceded all of the past 3 recessions. The most recent data confirmed that inventory growth continues to outpace sales, another problem that the U.S. economy may be facing. However, the GDP forecast for the first quarter of 2016 has rebounded through the month of February as economic data attributed to the consumer have improved. For now, the U.S. economy appears to be withstanding global economic pressures. The big question mark, as I mentioned earlier, is can this growth be sustained in the current global deflationary environment as China and emerging economies struggle? There are lots of schools of thought on both sides of this question. We would argue that there is still plenty of potential downside for the global economy, but certainly the wild card is still how the U.S. economy will be impacted in the medium term. We are closely monitoring this scenario for its implications on financial markets and correspondingly investment strategy. So let's have a look at what is happening in the rest of the global economy. Most central bank policies are based on their mandate for price stability. Concerns have focused on the recent deflation being created by commodity prices, and central bank monetary policies have been predicated on trying to get inflation to their 2% target levels. There has been gradual improvement, but inflation in most developed countries remains stubbornly low. There are plenty of economists and analysts questioning the effectiveness of some of the monetary policies, especially the negative interest rates that are now in Japan and in Europe. Well, Euro area companies represent about 16% of the world equity index. The European Central Bank eased monetary policy on December 3rd, but it was less stimulative than the market had expected. Amidst increasing market volatility, President Mario Draghi surprised the market with an announcement of more stimulus to come in March. Now, Minutes from the latest ECB monetary policy meeting showed that European Central Bank policymakers consider it necessary to review and possibly reconsider the monetary policy stance since its at its next meeting in March. While incoming information had confirmed the ongoing moderate recovery and had provided solid evidence that the monetary policy measures were working as intended, downside risks had increased again and heightened uncertainty about the growth prospects of emerging market economies, volatility in the financial and commodity markets, and of course, geopolitical risks. The next ECB interest rate decision comes on March the 10th. Japanese companies represent 8% of the world equity index. The Japanese GDP shrank by 0.4% in the last 3 months of 2015, dragged down by a fall in private consumption and housing investment. Preliminary estimates showed figures came worse than market expectations of a 0.3% contraction and compare with a 0.3% expansion in the third quarter of 2015. Companies in the UK represent 7% of the global equity index. The Bank of England Monetary Policy Committee voted unanimously to maintain the bank rate at 0.5% on Feb 4. One policymaker had been voting for a rate hike since last summer, but dropped their call as growth and inflation forecasts were lowered, signaling rates are likely to remain at record low for at least this year. Policymakers expect inflation to remain below 1% this year. GDP growth forecasts were lowered to 2.2% for 2016 from an earlier 2.5% estimate. Growth for 2017 was downgraded to 2.4% from 2.7%. There are significant economic implications for the UK as their participation in the European Union will be decided by a referendum that may come as soon as June. There are economic risks to a UK exit. There's the confidence shock, which would create uncertainty over post-exit arrangements and means that business investment would slip and household savings probably increase. That would reduce demand and have a negative impact on the UK economy. The credit shock, as UK banks will be seen as riskier and their borrowing costs would likely increase. And of course, the currency shock, where foreign direct investment flows would dry up. This week, the pound plummeted as the Mayor of London announced his desire for an exit from the EU. So there's more uncertainty there. Well, Chinese companies represent 2.5% of the world equity index. China's trade data was reported on February the 15th. Exports in China plunged by 11.2% year on year in January of 2016, following a 1.4% fall in December. Imports in China tumbled by 18.8% year on year, following a 7.6% decline the preceding month. It is the 14th straight month of contraction in imports as a result of declining commodity prices and weak demand. China's economy is still struggling. Gauges tracking both manufacturing and services based on surveys of more than 4,000 companies fell to new lows. The Minsin manufacturing index fell to 37.5 in February from 41.8 in January, while the non-manufacturing gauge fell to 37.5 from 43, according to the China Academy of New Supply Side Economics. Numbers below 50 indicate deteriorating conditions. For the moment, China's economy continues to struggle. In Canada, where companies represent 3% of the world index, consumer prices increased by 2% year over year in January of 2016, following a 1.6% growth in the previous month and above market expectations of 1.7%. It was the highest reading since November 2014 as food costs rose at a faster pace and gasoline prices went up for the first time since October of 2014. Food prices were up 4% in the 12 months to January after rising 3.7% in December. This acceleration was attributable to a gain in prices for food purchased from stores, which rose 4.6% year over year in January after increasing 4.1% the previous month. Prices for fresh vegetables were up 18.2% in the 12 months to January, following a 13.3% increase in December. The other fresh vegetable index, which we all know about, including cauliflower, broccoli, celery, and peppers, among other products, registered its largest year-over-year increase, 22.7% since April of 2009. The Canadian consumer continues to be cautious, with retail sales stalling out in December somewhat. Well, have you ever wondered where Canadians spend their money? For the year of 2015, Canadians' total spending at the retail level increased by 2.6% compared to 4% for 2014. Lower gas prices obviously impacted gas station sales. Electronics had the next biggest decline, and clothing sales appear to have benefited from lower gas prices. Interesting. Well, Finance Minister Bill Morneau says Ottawa is on track to run an $18.4 billion deficit next year, even before adding the billions in new spending promised by the Liberals during the election campaign. Well, the Liberals campaign on a plan to run deficits of $10 billion a year to fund new spending, which means that roughly estimated delivering on those promises would push the size of the projected deficit to nearly $30 billion. Ouch. Full budget will be announced on March the 22nd. So what do we see on the horizon? Well, let's check in with the bond markets because they do tend to lead other markets. Yield curves are all flatter as bond buyers who were afraid of higher rates before have found themselves short duration. And as they try to move longer at the maturity spectrum, yields of longer-term bonds are getting driven lower. Part of this is being forced by the easier monetary policies and negative interest rates of central banks, and in the U.S., some lessening of expectations of the next moves to tighten by the U.S. Federal Reserve. The spread or yield difference between investment-grade corporate bonds and safer government bonds has been widening as investors move away from riskier assets and also drive short-term government yields down. Historically, high-yield bond markets lead equity markets, and the current gap remains to be closed and makes equity markets look relatively expensive at the moment. Well, let's talk further about the equity markets. When investors buy stocks, they buy a stream of future earnings. The price-to-earnings ratio represents a metric to measure stock prices relative to earnings. The 10-year average price-to-earnings ratio is 14.2 times. Now, the 12-month forward-looking price-to-earnings ratio is currently at 15.4. At the equity market highs back in May of 2015, it was 17.1. So certainly less expensive at this juncture, but still relatively expensive. Again, when the green dotted line breaks through the blue line, that is when stocks begin to look more attractive, and we certainly shall wait for that moment in time. With 87% of companies reporting for the fourth quarter of 2015, the blended earnings decline for the fourth quarter is a negative 3.6%. For all of 2016, analysts are projecting earnings growth of now 3.4%. At the beginning of the year, analysts had projected growth for 2016 of 7.4%. So earnings growth expectations are being considerably reduced, in fact, cut by more than a half. The other metric that we like to look at is enterprise value to earnings. S&P 500 companies are valued at current market prices near 12 times. The long-term average is closer to 10 times, and that is too expensive for us. When investors borrow to invest, it can drive stock prices higher. When they pay down their loans, they tend to sell, so margin debt data tend to provide an indication of equity market direction. Margin debt turned lower last May, it is something that inspires our continued caution. When the spread between large cap markets like the S&P 500 widen over small cap markets like the Russell 2000, it is historically a sign of stock markets that are rising on the strength of fewer and fewer companies and is considered unhealthy. That had been happening, and there had been a reasonably wide gap between the S&P 500 and the Russell 2000. When markets fell, that gap narrowed considerably, but large cap markets have jumped back more than small cap markets over the last couple of weeks with the recent rally. Without small cap market follow through, we cannot consider the recent rally as anything more than temporary, again, which warrants caution. So what does it all mean? Since last May, we have taken a defensive posture to investing. In light of our key theme for 2016, we remain defensive. We have picked away at some value opportunities, but remain overweight cash for the time being. Central bankers and most economic forecasters are uncertain of the path of the global economy. So are we, and as Paul suggested in the Globe and Mail article a few weeks ago, we are quite fearful of the prospect of deflation in commodity prices. Our discipline, as we often refer to it, is at all times to protect our and our clients' capital, and especially so when we see the warning signs of potential problems. It is easy to stay fully invested at all times. That is why most advisors might recommend sitting tight on a fully invested strategy. In many cases, as non-discretionary advisors are required to do, it is significantly more difficult to adjust assets and positions one household at a time. That is why we use discretionary management, so that we can move all of our clients at the same time. We can be quicker, more efficient, and more impactful. Cash and cash equivalents have been important defensive assets, so we are carrying greater than normal cash balances in our models. With equity market values having fallen so rapidly to begin 2016, we were able to find some opportunities to add some reasonably cheap assets. Now, this does not mean there is a change in our defensive strategy. We are being patient and only adding small percentage weightings at a time, leaving lots of ammunition for future equity market weakness and assets with better value if and when we should get it. If we don't, we can and will adjust our strategy accordingly. Risk is significantly lower now than it was last May, so we are much more comfortable adding assets at levels where we do see some value. Now, our high rock models are built to incorporate the need for diversity and balance with fixed income, global equity, and the tactical mid and small cap companies. Now, as volatility increases, the cash in client accounts, the underweight nature of our exposure to equity markets, and the negative correlations between equity markets and bond markets helps to mitigate the impact of volatility on our portfolios. So far this year, our global benchmark equity index is down close to 7%, as I mentioned earlier. A typical 60% equity portfolio and 40% fixed income portfolio built with our models is down somewhere between 1.5% and 2.5%, depending on the structure. This is a significant mitigation of risk and volatility and is part of our ongoing and active management. Okay, so what's up for next week? Well, Thursday, we will see the latest data on the fourth quarter of 2015 GDP in the UK. We'll get Euro area and Japanese inflation numbers for January. On Friday, we're going to get Euro area February business and consumer confidence. We'll get the updated readings on the fourth quarter GDP in the US. We'll get a glimpse into the latest personal income and consumer spending, as well as that Fed targeted inflation index, the PCE core price index. Next week on Monday, we'll see some employment data coming from Japan. We'll see some manufacturing index data in China on Monday, and then On Tuesday, we'll see Canada's December and fourth quarter GDP data, with also some February data for U.S. manufacturing. And of course, next Tuesday, we will have another HIROC webinar. All right. Well, I've perhaps overstayed my welcome once again today, but that's it for our discussion. If anyone who is listening might have a question, this is the time to ask it. All right. Obviously, I've covered all the really important details. So if you do have a question laterally and wish to email us, we would be more than happy for you to send them. We would also love to get feedback on these webinars anytime that you wish, or what you think is good, what is not, or what else you might like to see us cover on these calls. But as always, thank you for taking the time to tune in. Have an excellent rest of the week and a great weekend. Don't forget to tune in next Tuesday. And until then, this is Scott Tomlinson signing off.